On this video of the Bedroom Investor Stock Valuation series, we will be discussing what is the difference between the trailing and forward price to earnings ratios. The trailing 12 months PE ratio is the PE ratio based on the trailing 12-month earnings of a company. Remember, TTM is equal to trailing 12 months, and it means how much a company has made in the last 12 months. In the calculation of the trailing 12 months PE ratio, where you divide the share price by the earnings per share, the trailing 12 months earnings is what is used in the denominator section of the formula. The trailing 12 months PE ratio is useful for assessing a company's historical performance. However, the trailing 12 months PE ratio does have its shortcomings. The trailing 12 months PE ratio assumes the company reported the earnings accurately. This leaves room for management errors or even foul play. The past performance does not equate to similar future performance, the trailing 12 months. Earnings per share denominator is fixed, whilst the current stock price is constantly changing. Hence, the value of the trailing price to earnings is always changing as well. The trailing 12 months PE ratio will change as the company's stock price moves because earnings are released each quarter, and the market reacts to the earnings report. The stock price also moves in general when the market is open, thus the trailing PE ratio is always in flux. Because of this, some investors prefer to use the forward price to earnings ratio, which is known as forward PE for short. When the forward PE ratio is lower than the trailing PE ratio, the company's future earnings is expected to increase, and conversely, when the forward PE ratio is greater than the trailing 12 months PE ratio, the company's future earnings is expected to decrease. Don't worry, we will cover this concept in more depth during the video and show proof as to why this is the case. Let's look at the forward PE ratio in more detail. Note that the forward PE ratio uses future earnings guidance as opposed to trailing earnings figures used in the trailing 12 months price to earnings calculation. Consider a company that is profitable. We know that the trailing price to earnings ratio uses the company's earnings from the past 12 months. This means that the trailing PE ratio relies on the past performance of a company. However, the forward PE ratio uses the projected future earnings of a company rather than the trailing earnings in order to compute the PE ratio. Also alternatively known as the estimated price to earnings, this forward-looking indicator helps investors to compare the current earnings of a company to its future earnings and can clarify what earnings will look like without changes and other accounting adjustments. However, like the trailing PE ratio, the forward PE ratio also has its shortcomings. One issue with the forward PE is that companies could purposefully underestimate their future earnings to beat the estimated PE ratio when the next quarter's earnings arrive. Another issue with the forward PE ratio is that external analysts covering the company may also provide estimates that diverge from the company management estimates. This could create confusion amongst investors looking to buy shares of the company. Let's summarize everything we now know about the trailing and forward PE ratios. The trailing PE ratio uses earnings per share from the past 12 months, reflecting a snapshot in the historical performance of a company, whereas the forward PE ratio uses projected earnings for the next 12 months. And the forward PE ratio is also often used to gauge investor sentiment about the company's growth prospects. So we have established that when the forward price to earnings ratio is lower than the trailing price to earnings ratio, that investors are expecting a company's future earnings to increase. But more importantly, why is this the case? First, let's consider the trailing 12 months price to earnings equation, where the share price is divided by the trailing 12 months earnings. Now we must also look at the forward price to earnings, where the share price is divided by the estimated future earnings. Note that FE in the bracket stands for forward earnings. Then we assume that the share price remains constant and the same for both the trailing and forward earnings. Under these circumstances, for the forward PE to be lower than the trailing PE, the estimated forward earnings must be greater than the trailing earnings. This is because as the estimated forward earnings increases, the forward PE ratio decreases. But it's important to not forget, this is only the case as long as the share price is assumed to remain constant and the same. We will now use numerical examples to further illustrate this concept. Let's assume that the share price for the trailing PE is $10. The forward PE share price is also $10. The trailing and forward PE share prices are constant and the same. Let's say for the trailing PE, Ann's Coffee Shop per share earnings was $2. The trailing PE ratio computes to be 5. For the forward price to earnings ratio, let's then say that Ann's Coffee Shop estimated future earnings per share was $5. The forward PE ratio then computes to be 2. As we can see from the equation, since the estimated forward earnings per share was greater than the trailing earnings per share, the forward PE ratio came out to be lower than the trailing PE ratio. The equation shows as the estimated forward earnings per share in the denominator increases, the forward PE ratio decreases. And this is why when the forward PE ratio is lower than the trailing PE ratio, investors are expecting a company's future earnings to increase. Now we will explore why, when the forward price to earnings ratio is greater than the trailing price to earnings ratio, why investors are expecting the future earnings of a particular company to decrease. Again, importantly, we will explore why this is the case. First, we must look at the trailing PE ratio, where we divide the share price by the trailing 12 months earnings per share, and the forward PE ratio, where we divide the share price by this time, the estimated future earnings per share. Like before, the share price for both the trailing and forward PE ratios must remain constant and the same. For the forward PE ratio to be greater than the trailing PE ratio, then the estimated forward earnings per share must be lower than the trailing earnings per share. This is because as the estimated future earnings per share decreases, the forward PE ratio increases. Let's use numerical numbers again to help explain this concept. For the trailing PE ratio, let's say the share price is $10, and for the forward PE ratio, the share price is also $10. The share price for both the trailing and forward PE ratios is again constant and the same. The trailing PE ratio earnings per share for Ann's Coffee Shop is again, like the previous example, $2. The trailing PE ratio computes to be the same number as before, which is 5. However, for the estimated future earnings per share for the forward PE ratio is now this time $1. This will mean the forward PE ratio will now compute to be 10. As we can now see, now the forward PE ratio is greater than the trailing PE ratio. You can see that as the estimated future per share earnings decreases, the forward PE ratio increases. This shows us why investors are expecting the future earnings of a company to decrease when the forward price to earnings ratio is greater than the trailing price to earnings ratio. That's it for this video. The next part to this video, we will be answering the question, what is a good price to earnings ratio for a company? The link to this video will be in the description below. If you found this video useful and gained value, then subscribe to our YouTube channel as we plan to release more videos in the future, where we look into depth about various financial ratios and learn how to analyze financial statements. You'll also receive notifications for when the videos are uploaded. Our goal is to make everyone around the world a better, smarter, and a more confident investor. So please share this video to someone you know who will gain value from this video. Thank you for your help in helping us achieve our goal. We'll see you again soon on our next video. Until then, happy bedroom investing.